All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks. I wanted to jump on here as we wrap up the week, walk you guys through some of our trading from this week. We'll take a look at a couple of our trades that we reviewed in last week's weekly recap. So I'll give you an update on how we're managing those and what we plan on doing with them going into next week. So happy Friday to you all. Made it through another wild and crazy market week. We just continue to see very big moves back and forth. We continue to see volatility pretty active. We'll talk about that more in just a moment. And we mentioned it last week. I'm not expecting the markets to slow down in the months to come. I just don't think they're going to be to the extremes that we have seen the last 3-4 weeks. I think it's going to be much more tradable. We've already started to see that here this week. We haven't seen the extremes where if you're not there the very moment that move starts, you miss things. We just have not seen that. It's been very, very doable to catch and manage trades here this week. So I'll walk you through some of that in more detail. And as we transition over to the charts, I will make my charts bigger. So just let me do that quick second so it's easier to see. All right. So I always like to start out with a daily chart of SPY. Anytime that I'm talking to our students or in a webinar like this, I want to start out with a very big picture view because this helps guide me in how I'm trading. What type of risk do I feel comfortable taking? How many contracts, how many spreads am I looking to trade? Am I looking to trade weekly or monthly options? It helps paint a picture of current conditions. I'm not using this daily chart to actually base my entry and exit points off of. It just helps me determine the risk level that I'm willing to take in my own trading. We've talked about this in previous sessions. I've got a mix of different moving averages here on the chart, a mix of simple and exponential moving averages. Nothing custom here, very basic, and I want that. I want it that way for a reason. I want to take a look at major support and resistance levels that could potentially come up. And with these moving averages, a lot of retail traders, a lot of professional traders look at these levels. You know, you've got the 20, 50, 200 period moving averages. I've got some exponential moving averages on there as well. So very, very reliable indicators when you're looking for overall market direction going into next week. So the levels that I was watching this week, we got up on that rally. It was an impressive rally off of the lows. We moved from 218 basically straight up to 260. That's an impressive move on SPY. We did find resistance right on top of the 20 period moving averages, both the simple and the exponential. No surprise that price action so far has stalled out right there. We have started to reverse back to the downside. The pink line there on the chart, that's the 8 period exponential moving average. And I'd like to look at that for a very short-term direction. And we did break it here over the last couple of days. We broke it right back down to the downside. So what I am expecting, I mentioned it last week, I am expecting another wave to the downside here going forward. I wouldn't be surprised if we get down and test the lows again down at 218.26. And here's why. For the last number of years, everybody has been programmed just to come in and buy every single dip, and it has worked. We saw another dip bought here recently. However, when you take a look at what caused the selling initially, you know, with the virus spreading worldwide, nothing has changed there. We haven't seen any type of a breakthrough as far as a treatment goes or a vaccine. We still have the virus spreading like crazy throughout the world. And until we start to see some improvement with the virus numbers, I am not expecting any type of a significant move to the upside. The rally here was off of the announcement that central banks worldwide were just going to pump trillions of dollars into the system to try to prop it up. Now that we've already priced that in, I would not be surprised if we get another push to the downside here going into next week. And then if we do get down and test 218.26, it's a long way down there. But if we do get down there over the next few weeks, look for that to be very strong support. I would expect there to be another bounce at that level. Now, if we don't get down to that level, okay, if we just get some selling into early next week, the first area that I'm watching next week on the downside for support is 240. That's the next level that I want to see tested on the downside. And then we'll just see how price action responds to that level. The volume here this week has started to contract, which is it was fully expected. When you start to see this type of volume here the last few weeks, when we were between 2 and 400 million shares on SPY on a daily basis, that's not sustainable. It was an extreme move. Now we're starting to see that volume contract. Here we are going into the afternoon hours, and we've only had 66 million shares trade today. That's nowhere near what we have seen over the past couple of weeks. Still an active market, but we're not seeing as large of a volume reading. We're also starting to see volatility contract a bit, even with the market down here today. You have the Dow down 400 points. You've got the S&P down 50, the NASDAQ down almost 150. You still have the VIX. You still have volatility lower as well. What we're seeing on volatility, we got such a strong extreme over the past few weeks. It was not sustainable there either. Now we're starting to see markets price this in as potentially more of a new normal, right? Where we've got uncertainty. You're going to have wide ranges back and forth. And because of that, the VIX has started to contract a bit. We have certainly seen volatility start coming out of many of the options that we trade. It's still elevated. We're still up near 50. But just a couple of weeks ago, we were up over 80. So we have certainly seen some volatility contraction here, which is good to see. I love it when volatility is active. But again, like I mentioned a few moments ago, if the volatility contracts, it's going to make it a much more tradable environment. And we've already started to see that here this week. So levels for next week, support level 240 and 218.26 as the further out support if we do get some nasty selling to kick back in. And then on the upside, the 8-period EMA that we just broke, as well as the 20-period moving averages above us, those all become areas of resistance again. So anywhere from 250 up to 260, we've got this little section right here that I'm circling. That's an area of resistance that we want to get up through. If we're going to get some traction on the upside, we need to break those levels on a closing basis. So those are some things that I'm looking at as far as big picture goes next week. How does this impact what types of trades I am looking at? Well, before we get over to some of the individual charts, let's just take a look at the VIX. I mentioned it already. We have seen this nice contraction here over the past couple of weeks from a high of 85 to now we're breaking 50 here today. Notice what we're also seeing with the ATR down at the bottom. It's this yellow line down at the bottom showing the average true range. We have started to see the ATRs roll over a bit. Still an active market, but not near as active as what we were seeing even last week. What this means for me, the reason I point all of this out, I continue to be active in this market. I mentioned it last week. I don't want to go to the sidelines. I want to be active. I want to take advantage of the movement while we have it. But it does not mean I need to be ultra aggressive. I don't need to jump in with both feet. I don't need to load the boat with a couple of big positions. I'm continuing to trade a larger number of small positions. All of the trades that we've talked about recently, we're talking about a couple $100 or less per contract or per spread. You can spread your capital into many different areas. And I think that's going to make a big difference going forward. Not only do we want to mix up the markets that we trade, we also want to mix up our expiration cycles, mix of weekly and monthly options. And then we also want to mix up our strategies. We want to trade some long calls, long puts, some debit spreads, some credit spreads. The better your mix of trades, the more consistent your returns will be over time. All right. So let's take a look. First, let's take a look at a couple of our trades from last week. For those of you that joined us last week, we talked about some of these trades in real time. So let me just clean up my chart a little bit so it's easier for you guys to see. And the first one that I want to talk about is a Slack, and it's symbol WORK. In the webinar last week, we were taking a look at this chart using our pulse indicator. This is the red and yellow histogram down at the bottom. And we talked about how there was a whole slew of yellow bars indicating that price action was overbought. We were between a 1 and a 2 standard deviation channel move on the upside. That's why those bars are plotting yellow. It does not mean the stock can't continue to move higher. It just meant it wasn't statistically probable. And when you see these types of ranges on the pulse, when you start to see this type of cluster of yellow bars, it'll typically lead to either a period of consolidation or even a reversal in the other direction. Lo and behold, look what's happened here. Has it been the biggest move to the downside? No. but we were able to close out of our winning trade from last week, which I'll show you over on the trade page in just a second. So what we were waiting for, I need 3 out of the past 5 bars plotting as yellow. We had that. We did get price action to close below our moving average, that blue and red moving average up top. That is the 8-period exponential moving average. We just have some custom colors there just to show us whether it's uptrending or downtrending. So once we saw the moving average roll over and price action closed below the moving average, it had us interested in putting on a neutral to bearish position. We didn't want to just come in and buy the long puts. It was just too aggressive. If I buy a long put option, the only way I make money is if that stock moves to the downside, and it does so quickly. I wasn't convinced that that was going to happen. I wanted a more forgiving trade. So another way of doing it is to use a short call spread. It still gives us a bearish tint on the trade, but we get a neutral kicker. If we just stay sideways, the time decay helps us. We also are able to benefit from volatility contracting, which it has the last week or so. When volatility contracts, it causes the options to lose value. That can hurt a long option, a long call or long put. In this case, a credit spread, we were stacking multiple ways of making money in our favor, increasing our probability of making money. So let's jump over to the trade page and let's just review this trade on work. And just give it a quick second to pop up. And there it is. So what we did last week is we went into the April 17 monthly options. They are now down to 14 days left to expiration. But last week, what we were looking at was selling the 30-32 call spread. So I'm going to come in here. And what we did is we went to the 30 call. We right-clicked. We went to sell. And we selected vertical. And it popped up an order down at the bottom where I was selling the 30 call and I was buying the 32 call at the same time. In doing so, it leaves me with a risk-defined trade. I know what my maximum loss is right up front. We collected 65 cents to put this trade on. We collected $65 per spread, and it tied up $135 of capital per spread. Very reasonable regardless of account size. You can take it with 1 spread. You can take it with 10 spreads, 20 spreads. I believe in the training last week, I placed this trade here in the training live. I want to say I got filled with 5 spreads. I ended up adding to the position later in the day. So you had no problem getting filled. It was a pretty easy trade to get in and out of at good prices. Now, you can see here the price, the current quote on this spread is 0. Had we held all the way to today, we would be looking at a full profit of $65 per spread. I did not hold that long. We closed this trade out here. We closed it out yesterday, and I bought it back for 18 cents. We mentioned in the training last week, we always target between 50 and 75% of our max profit potential. So I bought it back for 18 cents. It gave me right around 75% of my max profit. It was a $47 profit per spread. It was a 35% return on our capital in less than a week. I will take that trade every single time. You're looking at that initially saying, okay, $47 a profit, it doesn't seem all that impressive, but remember, we were only tying up $130 of capital to begin with. So it wasn't taking much. You could have traded multiple spreads here and still had, $1,000 at risk. Very doable. Not to mention, we had 5 ways of making money on the position. Ideally, we wanted the stock to move lower, which it did, but it didn't have to. We made money as if the stock moved up, down, or sideways. As long as it stayed below $30 a share, we were okay. We made money if time decay added up, and we made money if volatility decreased. All 5 of those happened over the past week, and we were able to close it out, book a really nice profit. Okay, now if you still have the position on, would I continue to hold for the next 14 days? Ideally, no, I don't want you to hold for the next 14 days. And here's why. With markets this active, if we get some type of a headline to hit over the next 14 days, where all of a sudden there's this breakthrough on the medical side with the virus, and the market starts to rally up. If work goes from 24, which it's trading out right now, if it goes from 24 up to 30 or above, we could potentially go from a full profit to a loss. I'm not willing to take that risk in this market. I would rather take the profit, free up the capital, and move on to the next trade. This is not a market that you want to swing for the fences at. I've been talking about that a lot with people. I know the moves are big. I know it's tempting to want to say, hey, let's just go for the big winners, because if I can hit one or two big winners, it changes the whole ball game. While that might be true, it's a very high risk environment right now. Markets can reverse on a dime. I would rather take my profits while I can, right? And I've been shooting for, just looking at some of our winners here over the past week or so, we've been looking, we've had returns anywhere from 20% on up to 80%. When I say that, I'm talking about return on capital. So we're still booking some really nice profits. We're just doing so in a more conservative way. Okay, so we are now out of the trade on Slack, and we will move on to the next position. Let's take a look at XLE. This is the energy ETF that we talked about here last week as well. And let's just take a quick peek at the charts over on XLE. And then we'll walk through the trade. And because I still have this trade on, I want to walk you through how I plan on managing it. So XLE, we were still using the same pulse indicator that we used over on work, but in this case, we had the pulse indicator plotting yellow on the downside, indicating that we were very oversold. The energy markets have been absolutely clobbered here the last number of weeks. And as a result, many of them are oversold, potentially giving us an attractive area to look for a bounce trade, looking for either a period of consolidation or a reversal to the upside. And what we talked about doing last week, we had price action start to bounce a little bit. We had some movement up above our 8 EMA, which is the blue and red moving average here. So we came in and we sold a put spread. Specifically, we sold the 26-24 put spread out in the May monthly options. Those are the options that now have 42 days left to expiration. I did it here in the session last week, and I got filled on 5 spreads. You can see that position is still open. Right now, we are down $200 on the day, but we're up $20 on the position since we opened the trade. So let's break this one down in more detail. Let me just go ahead and create a closing order here so we can see it. We sold the 26 put and we bought the 24 put at the same time. It left us with a risk-defined trade. We collected 60 cents per spread. It tied up $140 of capital per spread to put the trade on. It's now trading for around $52 or 52 cents mid-price. We've got a small profit. What do we want to have happen here on this trade? First of all, we've got 42 days left to expiration. We still have plenty of time here. We're in no rush to close the position out. My target zone, because I collected 60 cents to put the trade on, I would love to buy this spread back for between 15 and 30 cents. That would allow me to keep between 50 and 75% of my max profit. So I mentioned last week, we already have a closing order working at 15 cents. I do not have an order in place for the stop. And I'm going to circle back to that in just a moment and walk you through why it's tricky in this market to place stop orders. It can be dangerous. You can get burned by them. And I'll show you why that is in just a second. So I'm going to continue to keep this position on. Not going to overmanage it. Not going to take it off here and say, oh, it's starting to reverse against us. Let's take the partial profit while we have it. We haven't hit a target zone. I was willing to take the Slack trade off for a partial profit because we were inside of that 50 to 75% window that we're looking at for a profit target. We're not anywhere near that level here on XLE. So I am going to continue to keep the position on. My risk hasn't changed. Same profile on the trade. I still am looking for either a sideways move on XLE or a move higher. I just need XLE to stay above 26. It's now trading for 29.5. We've got about a $3.50 cushion that this thing can move to the downside before we're hurt. So nothing has changed here on this trade. Still like the position. I'm going to continue to hold it here into the next few weeks. So we'll circle back next week. We'll keep you posted on this one, let you know how we plan on managing the trade. Now I mentioned, and we'll get to a new trade here in just a second, guys, a trade that we're going to place today and get that going for next week. Before I get to that, let's talk about, I'm going to show you an example using Tesla. because we do have a position on with our NASDAQ Options Superstars program. We put this position on with our students here earlier in the week. We came in and we used the April 24, the weekly options with 21 days left. And we decided to put on a debit spread. It's an expensive stock. It's a very volatile environment. We wanted to use a debit spread to lower the cost of the trade. So we came in and we bought the 480, 470 put spread. So we were buying the 480 put, we were selling the 470 put at the same time. We bought this trade, we bought this spread for $4.78. So it tied up $478 of capital. We mentioned to our students that we want to use a 50% stop on this trade. If this trade is down 50%, we'll go ahead and take the position off. I'm not willing to take the full 100% loss. My stop is at $2.39. That would be the 50% level. Here's why it's dangerous to place stop orders ahead of time. In this market, some of you have noticed this. When the volatility gets this extreme, the bid-ask spreads widen out. Things get really wide. You can see here on the 480 puts, 65-cent difference between the bid and ask prices. The 470 puts, almost a 90-cent to $1 difference between the bid and ask prices. Those are actually much wider this morning, right at the open. When the market opens and you have these big overnight moves, the markets can be very wide for the first few minutes of the session. And as a result, the option quotes can cause chaos for potential working orders, specifically with the stops. Meaning you could have your stop hit in the first 60 seconds of the session. Basically, I'm not going to call it a bad print, but basically because the bid and ask prices are so wide. And we actually had a customer here this week that actually placed a stop order, and the stop order was hit within the first couple of minutes of the session. And and the trade was taken off. When in reality, 5 minutes later, the trade was right back into profit once the markets started to tighten up. That is a big reason why I do not like to use stop orders as working orders. When I talk about using a 50% stop, it's a mental stop. I'm still going to respect that level. If we come in and see that this spread is trading for $2.39, I will take the trade off. I'll just manually come in and get that order placed. Okay, so it's important to stay disciplined. We absolutely do, but I want to go ahead and prevent those trades from getting wiggled out because of the wide markets. It's so crucial in this type of a market when we have big swings back and forth, wide bid-ask spreads. You just want to be very, very careful with those stop orders. And with technology the way it is these days, I'm not expecting you to sit there and watch your platform all day long from opening to closing bell. You don't need to. You can set price alerts for yourself. You can have those alerts sent to a mobile device, a phone, an iPad. That way, if you're out and about, I know it's more difficult these days to be out and about with everybody stuck at home. But if you are out and about or you're not by your computer, if you have an alert pop up on your phone, you can immediately come and check your position in literally 30 to 60 seconds. I'll do that periodically throughout the day. If I'm busy with customers or if I'm out and about, all I have to do is pop up my mobile platform, take a look at my trades, and get orders placed as needed. All right. So just a word of caution there. Just be careful with the stops for sure. And especially on some of these big tech names that have pretty wide bid-ask spreads right now. Tesla, Amazon, Google, Netflix to some extent. I mean, they've got some pretty wide bid-ask prices. So you want to be careful in those types of environments. All right, now let's go back over to the charts and let's take a look at a trade for next week. The last couple of times that we've connected here, I've spent a lot of time talking through credit spreads. And I love the credit spreads. It's my mission to get more people interested in those credit spreads because there's still a lot of fear out there. People that don't understand those trades and think that they're higher risk. We have shown here lately, they're actually not. They're much safer. They tie up less capital and they give you 5 ways of making money. They're a much more forgiving type of trade. However, the credit spread is not the holy grail. I love it as a strategy, but it's just one tool in my toolbox. Not going to use it exclusively. I'm going to be very active with them over time, but I also want to mix it up. I want to mix in some debit spreads. I want to mix in some long calls, long puts. I'm just going to be very selective when I use those types of strategies. I just showed an example of Tesla using a debit spread. We put that trade on earlier in the week. And now I want to take a look at the silver ETF, symbol SLV. Everything that I do as a trader is technical based, meaning I focus on the technicals on the charts. I'm not looking at fundamentals. I'm not going out and trying to predict what the Fed is going to do, what interest rates are going to do, how much stimulus they're going to announce. That's going to drive you nuts. In my opinion, everything that we need to know is going to be baked into the price on the charts. So when I talk about putting on a bullish trade on silver, it's going to be based strictly off of the chart pattern. It's not based on what's going to happen 6 months from now, a year from now. It's based on the price pattern on the chart. And here's what I'm looking at. We have another histogram down at the bottom. It's what we call our sentiment histogram. It's the red and the green histogram down at the bottom. If it is red, the bears are in control. If it's green, the bulls are in control. What I am looking at here on silver, I want the sentiment indicator to be green, which it is. Okay, just yesterday it flipped from red back to green again. Okay, that's what I need for a long setup. And then I want to look for some confirmation up top. Ideally, here's what I'm looking for. I want price action to be above my 8-period EMA. Again, it's that red and blue moving average. I also ideally want that moving average to be trending up. It's trending upwards when it turns blue. And actually, let me get the other one off of there. The other one is a 5-period EMA. We use that more for trade management. So let me just get the other one off. There you can see that we have a blue 8 EMA, signaling that we are in an uptrend, and we have price action above the 8 EMA. What I am looking for here on silver, I am looking for a break to the upside. I am bullish on both gold and silver here going forward. Okay, now again, this is not a trade that I plan on holding for 6, 12 months. That's not what we're looking for here. I am looking over the next couple of weeks for a break higher in both gold and silver. I'm using silver for this trade because I've already got a couple of gold positions on. So I want to go ahead and get a silver position on as well. Not to mention the silver ETF is a $13 ETF. The gold ETF, symbol GLD, is a $150 ETF. So big difference in the cost of the ETFs, big difference in the price of the options as well. So we're going to take a look at buying a long call. I'm going to mix up the strategies. We're going to go away from the credit spreads here this week and just show the flexibility that options give us. And we're going to take a look at buying the long call. Again, green sentiment indicator, price action up above the 8 EMA, upwards trending 8 EMA as well. So let's go over to the trade page and let's talk about how to structure this position. And I'll get rid of Tesla down at the bottom. All right, so we're going to go to the May monthly options. We're going to go away from the weeklies. We're going to go out to the May monthlies with 42 days left. Couple of reasons why I want to do that. The farther out in time that you go, the options get more expensive, which can be intimidating at times, but it also starts to put some things in our favor. The farther out that we go, the less sensitive the options are to changes in stock price, to time decay, to changes in volatility. It's a way to get a little bit more conservative. The closer we get to expiration, if we go with some of these shorter term options, they're going to be very cheap, which is attractive to many people, but they're cheap for a reason. You need a lot to go right when you're buying a long option in a weekly cycle. I want to go a little bit farther out in time, just in case we don't get an immediate move in silver. Maybe we get a little bit of chop to kick in here. So we're going to take a look at the May monthlies with 42 days left, and we're going to go to the 13 calls. I like the 13 calls for a couple of reasons here. Number one, the delta is at 0.60. The delta tells us how much the option is going to change for every $1 move in the price of the stock. I ideally like to see the delta between 0.6 and 0.65. It typically gets me 1 to 2 strikes in the money from the current price on the chart. So that 13 call gets us slightly in the money, gives us a delta of 0.6, and also take a look at the volume and open interest. It's a pretty active It's a pretty active market. We've got 15,000 contracts of open interest and 670 that have traded today. As a result, it's a pretty tight market. There's only a 3-cent difference between the bid and ask prices. That's going to mean it's going to be very easy for me to get in and out of this trade quickly and at good pricing. So I'm going to go ahead and click on the ask price of the 13 call. It's going to pop up an order down at the bottom. I can go ahead and change my quantity here. Right now it's set to 1. You can change it to anything you want. We can change it to 5 or 10. Let's just go ahead and start out with 5 contracts just to keep it simple. We can always add to it here in a few moments. There is a 3-cent difference. Actually, it's now down to a 2-cent difference between the bid and ask prices. So the mid price is at $1.12. I know that because there's this little price ladder down at the bottom where it shows my mid price and the full ask price. I'm going to go ahead and place my order at the mid price at $1.12. See if we can get filled there. So I'm going to go ahead and click on confirm and send. And right now my order is working. I am not filled yet. So you can see down at the very bottom, there's a position line and my order is still working at $1.12. Now, here's what you can do. Here's your options. You are not filled yet. You could let the order work. If you've got some time to watch it over the next 5-10 minutes, you can just let it work here at $1.12 and see if you get filled. If you don't have time, you've got to get back to other things. Maybe you've got some work commitments. What you can do, let's go to our working orders down here. And let's see if I can find... Okay, there's my silver order down at the bottom. I can right click on that order and select cancel replace. That's going to create another order on the screen where I can adjust the price. If I adjust it up to $1.13, I adjust it up by a penny, I should get filled pretty quickly on this. So here we go. I'm going to go ahead and click on confirm and send, and I should get filled pretty quickly. And there we go. So now I am filled on the position. I've got 5 contracts on down here. I was filled at $1.13. So where's my target? Where's my stop? Anytime that I buy an option, my target is always going to be 100% return initially. So my target is going to be at $2.26. My stop is going to be at 50% of what I pay for the option. So my stop is going to be down around 56 cents. I can create the closing order for the target immediately. Remember what we just talked about on the stop. I am not going to get my stop order in place. I'm going to use a mental stop there. That way I don't get wiggled out of the trade early because of wide markets in a volatile environment. So I am willing to create a closing order for my target. So I can come down here, right click on my position. Once I right click on it, I have the option to create a closing order. And I am going to set this closing order to $2.26. So I'm going to set it to $2.26, and I'm also going to change it to a GTC order, or a good till canceled. That way, over the next 42 days, at any point over the next 42 days, if it gets up in trades for $2.26, I have the potential of getting filled there, booking the profit. So I'm going to go ahead and click on confirm and send. So now my closing order for target is in place, and then I'll just continue to watch it. I'll come in. I typically check my trades 2 or 3 times a day. Typically 20 minutes or less is what it takes me to come in, take a look at my trades, take a look at the charts, get everything updated, and then move on with my day. So as I come in over the next few days, I'll just make sure that we have not seen price action get down to 56 cents. If I do see it has hit 56 cents, I will go ahead and close out of the position and take the stop. So absolutely a bullish trade here on silver. The only way I make money on this trade is if silver moves to the upside. And ideally, I want that move to happen sooner rather than later, because every day that I hold, there's going to be some time decay that comes out of these options. All right, so just wanted to show you a way of mixing up your trades here. I love the credit spreads. Certainly looking for credit spreads here this week as well. There's a lot of candidates out there in this market for credit spreads. So if you ever have questions on the trades that we cover here in these sessions, feel free to email me, mike@netpicks.com. The goal of these sessions, not to sell you anything. It's just I wanted to keep you guys in the loop on how we're navigating these markets, what types of trades we're looking for. If you would like more details, because these are the types of trades that we send out to our customers each and every week. We send out between 3 and 5 trades each week with our signal service. If you would like more details on the signal service, let me know. send me an email, mike@netpicks.com. More than willing to connect and help out there. Now, the indicators that I showed today on the charts, the pulse indicator, the pulse histogram. Let me actually get you a link, pop up a link here on the screen. Here's a free ebook. And this ebook, just go ahead and download it. It'll walk you through how to set up that exact setup using the standard deviation channels. How do we look for a credit spread opportunity? How do we structure the credit spread? How do we set it up? All you have to do is go to netpicks.com/8-minute cookbook, and it'll outline that very setup in more detail for you. So take a look. Let me know what you think. Let me know if you have any questions. And speaking of questions, let me see if there's any questions, comments. See a couple of you chimed in right towards the start of the session. So if you have any questions on anything that I've covered here today, or have some questions on market conditions going into next week, go ahead and get those in now. The plan, I'll try to get back in a couple times next week. We'll take a look at our options trades again next week, see what the market gives us. So if there's no more questions coming in, I'm going to start to wrap it up here for today, guys. Enjoy your weekend. Everybody continue to stay healthy as much as possible. And if there's anything that we can do to help out with your trading over the next few weeks, let us know. We'd love to connect. So enjoy your weekend, everybody, and we'll talk to you guys again next week.